Hi, today we're going to talk about the most important step before you start your house hunting, and that is the pre-approval process. We're going to cover what's involved in getting pre-approved with a lender, and also we're going to cover what type of loans will be available. Hi, Christian Fouts at the Fouts Group with MVP Realty. So today we're going to talk about first the pre-approval process. And a lot of people don't understand how important that is, and even more so in today's hot real estate market, right? Any realtor will tell you that the seller wants you to send in either proof of funds that you're going to be paying cash, or they want to see your pre-approval process. So it is imperative that you get that done before you start looking for any type of property. Many people think that the pre-approval process is going to take a long time and very cumbersome. They're going to have to go through years of tax returns and bank statements. Fortunately, in today's technology-driven world, it's very easy. Everything is online, and you start the process by going to your lender's portal. They're going to ask you to put in your name, your address. They're going to make you sign a form that's going to allow them to pull up and do a credit check. So you'll have to give your social security number. They're going to probably ask you to fill in how much income you make, and if you and your spouse are going on a loan together, they're going to want to see both of your income statements. So you're probably going to be required to upload maybe your last two most recent tax returns, give them a summary of your assets, your current liabilities, like if you already own a home, if you have outstanding credit card debt, a student loan, or maybe car payments. So they're going to gather all your financial information. They're going to do it all online, and then within 24 hours, generally, you'll have back your pre-approval. It'll tell you how much of a loan you can qualify for. They'll give you an estimated interest rate and any related expenses with your loan approval. So there are three most common type of loans. Okay, the first one is the amortization, which is what pretty much everybody knows. It's your fixed loan over a certain period of time. Majority of the people take out what's called a 30-year, right? Fixed amortization 30-year loan. You also could do it for 10, 15, or 20 years. In today's environment, right now, and sitting here September 20th, 2021, your 30-year loan rate is under 3%. So majority of the people today are taking long-term rates because we've never seen interest rates this low in the past 40 years. We may not see them again for another 40 years. The second most common type of loan, which was really, you saw it a lot of it in 2005 and 6 before the last bull real estate market we had, which is they were called adjustable rate loans. And those are usually for 1 to 3, maybe up to 5 years. The rates start off really low, but they adjust each year and they get higher. They do have an annual cap on how much they can go up, and they also have a lifetime cap on how high the interest rate could go over the course of the term. So the second type of loan is the adjustable rate loan. And we really don't see that much this day with rates being so low, but back before the last boom and bust cycle, 2007 and 8, you saw a lot of interest rates were higher. People took out short-term loans, 1 to 5 years. You start off at a really low rate, and then it adjusts each year depending on the formula or the type of loan that you signed up for. But there is an annual cap on that, meaning it can't go from 2 to 5%. And there also is a lifetime cap. So if you have an adjustable rate loan, say for 3 years, it can only increase so much over 3 years. And then the third type of loan is what's called a balloon payment loan. Those are generally used where people are buying an investment property. Maybe they're buying a property that they want to rehab, fix up, and then resell. And they want a loan maybe for 1 year, and then at the end of the 1 year, they're going to sell the property, and they can repay that balloon payment. The second common balloon payment is where you're doing new construction. Your builder tells you that he or she can build your house within 12 months. You go to your bank, they give you a construction loan. It's usually for 1 year. When the house is done at the end of 12 months, you owe the bank the full amount that you borrowed. So for the rest of this video, we're going to focus on amortization loans, specifically 30-year fixed rate loans. Two different types. You have conventional and government loans, okay? Conventional loans are your typical loan in the past where you had to put down 20 to 25%. That's not the case in today's market. You can put as little as 3%. And then under the conventional, you have what's called conforming and non-conforming. Now, what's the difference between those two, okay? Conforming loans are loans that meet either the Freddie Mac or Fannie Mae guidelines. Those are not government-owned agencies, but they're government-supported agencies, meaning they basically insure the loan. So they make those loans a lot less risky because they know if it goes into default, the lender knows that the U.S. government's going to basically support it. The other type of loan is non-conforming, which basically means it doesn't meet either Fannie Mae or Freddie Mac guidelines. Those type of loans usually carry a higher interest rate and higher fees. What is the difference between the conventional and the government loans? Well, the first thing is the amount of the down payment that you require. With FHA loans, you can put as low as 3.5% on those, and the interest rates are usually very competitive. The second part about the FHA loan is you can have a lower credit score. In today's environment, 680 or under, you go to the FHA. To get the conventional route, you need to have a higher credit score over 680. The other part of that is you can have a higher debt to income ratio, meaning how much debt you have to your income versus conventional, you cannot have as high of a debt income ratio. So the benefit of the FHA loan is that you can put a much lower down payment than conventional, as low as 3.5%. The second part of that too is your credit score can be a lot lower for an FHA loan than it is for a conventional loan, which would require a higher higher credit score, that is. However, with an FHA loan, since you are putting down a much lower percentage, they require a mortgage insurance premium, which means you have to pay a premium every month for mortgage protection insurance, and it never goes away. You have to pay for that the life of the loan. So to recap today's videos, there are 3 different types of loans. You have amortization, adjustable, and balloon payment loans. Under the amortization type of loan, you have conventional loans and you have government loans. With conventional, you have either they're conforming, meaning they meet Freddie Mae, Fannie Mac guidelines, or they're non-conforming, they don't meet their guidelines. And then the government loans, you have either FHA loans or VA loans, which are available to our veterans. Well, I know we covered a lot of information today, but hopefully you found out that the pre-approval process is not that difficult and you learned a little bit about the different types of loans that are available to you. Please feel free to reach out to us if we can provide you with any additional information, and stay tuned for our next video.